My bank told me that I need to tell them to pay principal when I send my payment, regardless of how often. How is that calculated? Well, it's calculated the same way. My guess is that you escrow your payment, meaning some of your money that you're paying on your payment goes to taxes and insurance, and they're putting that money in an account for you. What they want you to do is let them know that any extra money you send them, that you want it applied to principal, because the default is, I don't know why this is, folks, but the default is take the money and put it in your escrow account. That's the default. Why shouldn't the default be putting the extra money on the principal payment? But that's not their default. Their default is to put it in the escrow account. So that's why they're asking you to do that. It's calculated the exact same way. Based on how much of their money you still have, you're going to pay a certain amount of interest. Now, I'm going to get into this a little deeper and show you, folks, how the interest is calculated each month on these loans and why it is so expensive, since Danielle asked that. Danielle, would you like to see how the bank turns a 7.3% interest rate into 146.806%? You want to see how they make it so doggone expensive? If you want to see how expensive, put a number 1 in the chat. Put a number 1 in the chat if you want to see how the bank actually calculates this interest. We're going to show you how it's done. Okay, watch this. This is how it's done. I used to think that if I had an interest rate, they were taking how much I owe and then somehow multiplying it by the interest rate, and that comes up with the payment somehow. But if I did that, the amount of interest that I would pay would be a lot less. I would be taking 7.3% of $290,000. Okay, let me show you what's really going on behind the scenes that most people don't know. Okay, watch this. So we're going to bring up my calculator here, put that on the screen. Okay, now, whenever the bank has the principal balance, this is how they calculate it when you know what your interest rate is. And in this case, the interest rate is 7.3%. So we're going to take our 7.3, okay, turn it into a percent, okay, 7.3%, which is 0.073. So we're putting it in our calculator as a percentage, 0.073. Then we take 0.073 and divide it by 12, and we get 0.00608 and a bunch of threes. They take that number and multiply it by the unpaid balance. So we have a principal balance on line 1 here. And so I just took the 1/12 of the interest rate, okay? 1/12, I took the interest rate and divided it by 12, and I got 0.00608333333, okay? And now we're going to multiply it by the unpaid balance on line 1. That's $289,776.01. Okay, watch this. Watch this. So I'm going to multiply it by 289,776.01. Okay, that equals 1,762.80. If you look here on line 2, you'll see 1,762.80. Okay, folks, and I need to point out here, so by doing this every single month for 360 months, it is not one mortgage. By doing it this way, they create 360 separate mortgages. That's why it is so doggone expensive, because the next month, instead of charging you $1,762.80, the next month, they're going to charge you $1,761.43, almost as much, because they're doing it in this way. That's what makes it so expensive. But guess what? The same thing that makes it so expensive, if you know what to do, you can save at the same rate they're charging you. My name is Don Daniel, founder of P.I.L.L Method International, and our team created the most powerful money management, wealth building, debt elimination system ever created. At our recent seminar in Nashville, Tennessee, the keynote speech was delivered by the #1 motivational speaker in the world, Dr. Eric Thomas. E.T., as he's also known, mentioned he paid off his mortgage in 4 years using the P.I.L.L Method. I invite you to watch and listen.
Listen to me, y'all. One of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.
Did you hear that? No mortgage, no stress. If you would like to become debt and mortgage free within an average of 7 to 9 years by cutting your interest costs by up to 75%, go to pillmethod.com and request a savings and earnings report today.